Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Sorry, I'm a little bit like, I'm trying to figure out what's going on. So we have the market. It's moving around quite a bit here. Actually, let's just come over here. Here on this chart, we had a pretty decent decline in the overnight and a switch back, and now a little bit of volatility back and forth, and I'm getting a lot of clicky click in the treasuries. Oops, I didn't want to do that. I'm getting a lot of, big orders here. So I'm trying to figure out what's going on. I'm just coming back here. So for the numbers, how come I'm not getting... Well, let me refresh this page. Okay, ADP employment change, much lower than expected, 122,000 versus 140,000. Was at 615. So that was maybe this climb back up. Initial jobless claims lower than expected, 201K versus 215K. No clear explanation for the larger move, though. I'm gonna come back here. Did I read? I mean, I did my morning reading, but we do have Fed's Waller speaking, or we did. Waller, some of the ongoing services inflation may represent lagged wage increases. Somewhere I'm reading 187. Oh, okay, that's continued jobless claims. Jay Constant, what's up with Trump wanting to take Greenland, Canada, and the Panama Canal? What makes him different than Putin or Xi? I think this is so funny. Okay, well, I can explain what's going on here really easily, okay? Donald Trump has press conferences and the media asks him stupid questions and he answers them, right? Like, And I honestly, I think that there may be some degree of the media has kind of figured out the way that he does things and garners attention and his whole like tough guy shtick. And so they are asking him questions specifically to generate the most ridiculous headlines that they possibly can. Okay. So like, why are they talking about Greenland? Because a reporter asked him, would you rule out military action with Greenland. Or I don't remember exactly how he posed the question, but they basically asked him, like, would you rule out military action in Greenland? And his tough guy shtick, he has to say no. And so then you get this whole thing that's like, okay, so we're gonna bring in Canada and Greenland. I don't think that we can just bring in all of Canada as states right away. So let's make Canada just a giant territory, and maybe Alberta can apply for statehood. Just Alberta, right? And then that's like the whole thing is ridiculous, and it is, quite frankly, just another example of the way that media works that is maybe not necessarily in your best interest, and certainly not in the interest of like you being the most informed, right? So like I honestly have not spent a whole lot of time thinking about these things. The Panama Canal thing might be a little bit different, okay? The US gave the Panama Canal back to Panama during the Carter administration. Ronald Reagan at the time thought it was a bad idea. You know, conservatives have always thought it was a bad idea. Now, the canal is kind of atrophying, and like Chinese businesses are taking it over, and China kind of seems like China wants to include the Panama Canal in part of its global empire that it's trying to build. So that one, well, I doubt anything would happen with it during the Trump administration, is a conversation that is worth listening to, and the pros and cons against, you know, the United States owning it and all of that. But the chances that they're actually going to go and use the military to take the Panama Canal back by force, or to invade Greenland, it's absolutely not going to happen. And the only reason the media is talking about it is because they asked him the question. So this is like entirely a concoction from the media. I mean, sure, Donald Trump said the thing. He said the thing. But it's his tough guy shtick. It's not going to do it. And meanwhile, everybody's paying attention. Everybody is paying attention to whether or not Donald Trump is going to invade Greenland, they're forgetting about, well, what kind of tariffs, or to the extent thereof, the tariffs will be when Donald Trump takes office. The things that like actually matter to policy, because there's going to be a lot of real changes coming up here in a week and a half now. And I'm not seeing a whole lot of discussion about it. We don't entirely know what they will be. We kind of know what he promised. We don't necessarily know what exactly he's going to do, you know? So there you go. By the way, Rurd, welcome back. Value spaghettification period. I don't know what you mean by that, but the whole thing is ridiculous. Okay, Waller is still speaking. The labor market is not behaving like an economy that is overheating. I agree with that. You know, we've gotten some numbers in the past few days that look pretty good, but it looks to me like the economy is really feeling the effects of higher interest rates. And that combined with companies taking more time to interview people is making the labor market incredibly tight. There are people, like the number of people that have been unemployed for more than 6 months has like doubled in the past year. Right? So I am not sold. More broadly, you know, we haven't really gone through our charts. So let's do a little bit of that now. But I want to start by looking at the daily 10-year chart here. Okay, so in the past 2 to 3 months, the treasuries have fallen significantly. Remember that way back over here in, what was it, October? Or maybe it was the end of September? I don't remember when. Somewhere around here was when we did a 50 basis point cut. And then ever since then, treasuries have been down and interest rates have gone up. Like, what? And that's after, like, we did a 50 basis point cut, then what? We're like, what, 2 more cuts after that? And now they're not saying that they're going to raise interest rates. They're saying that they're just going to keep them here for a little while and see how that goes. And yeah, the treasuries are like selling off like mad. I don't know if that really makes sense, especially if the labor market is kind of tight and not really showing signs of overheating, as Fed's Waller just said. So that's where we're at in the treasuries. I kind of question how much this downside action can persist. One of the things that I also see, by the way, in the S&P 500 is that we are seeing some of the professional world kind of take profits / selling. And there's kind of some signs that the flows are going to flip here. At least for the first little bit of the year, you might see a bit of a bear market, and maybe even enough to get back down to like the 200-day moving average, perhaps. So, with all that in mind, let's kind of look at it on a 30-minute basis so you can see we made a little bit of a move lower overnight. We're trying to recover that. So far, though, it kind of looks like the treasuries have found a range to hold. There's the S&P 500 kind of took a bit of a hit yesterday, especially towards the end there. So when Donald Trump's press conference came along, they moved quite a bit lower, right? Here's oil. Okay, so oil has kind of started to get this high volatility area. But in the past day, they have rocketed right back up there to the highs and briefly breached 75. When I see a lot like really heavy volatility like that, that's often a sign that a change is coming into the market. So I'm still a little bit cautious about this momentum continuing, but it is up there at the highs at the moment. Maybe it's just going to blast right through. Here's gold and silver, so they've kind of been holding here. They're looking okay, but it's definitely moderated here today. Copper, holding those gains after a pretty big jump to start the week, and then the dollar rocketing right back up there to 109. And this is the one that I think is kind of the most interesting, possibly, in the market right now. Because Donald Trump's entire goal, basically, is to help rebuild America's working class, and and to rebuild our manufacturing base. And I really don't see how you do that with the dollar index at 109. I really don't see how you do it. Now, I'm also not sure how you get the dollar a lot weaker without, like, there being inflation involved, but hey. Something here's got to give. Then we got Bitcoin. There was a bit of a jump yesterday, but as the day went on, they sold, and it was a much bigger sell. I'm a little bit concerned here for them now. If they start to go to below these swings and you start to get momentum on the downside at below 90,000, because this thing is just like a house of cards. It's a tinderbox ready to go. My everyday Michael Saylor is throwing more fuel on the fire, and if things go the wrong way for them, it's going to blow up. This is so I've talked about this study before, but there was a study where they looked at market impact, and basically what happens is when you own options, you, at the end of the day, you see what the options are worth based on the price of the stock, and that determines how much money in the account that you have, how much a margin that you have. So if the thing goes up and you make money on the options, then you can potentially use that money to buy even more of the thing. So some people were doing these things where they're like buying far out of the money calls and just doing it over and over and over again, and it just keeps pushing it up and up and up and up and up and up until it gets to a point where there is a day where that moves down against them that is enough to force them to have to liquidate part of it. And they've shown mathematically that that a position like that can get to a point where it is guaranteed to fail. That basically, if there is a large enough decline, that then after that, the entire position has to be unwound because of their impact on the markets. And this is all kind of to show that really in valuing their portfolios, that the impact of selling should be factored into it, is really what this was intended to show. And this all sounds very much to me like what they're doing with MSTR. He's putting bonds out there and raising money with bonds and then turning around and buying buying Bitcoin with that money. And then that in turn pushes MSTR up so that he can offer out even more bonds. And there is going to be a point at which, if there's a large enough decline in Bitcoin, they will be forced to liquidate it and it will destroy the Bitcoin market. Now, that decline is not guaranteed. That decline is not guaranteed, but there's enough of a decline that then the whole washout would be guaranteed at that point. And I don't know where that point is, but it scares me. It scares me because I think there will be some pretty massive fallout if that happens. And this decline in Bitcoin, a little bit scary, especially since it seems like that this whole upside run was based on MSTR's buying. So if MSTR did all of that buying and now they're underwater on those new purchases, that's concerning. If the 10s go to 5%, heads will explode. Yeah, well, they were saying that, there's kind of been this rule in markets that if interest rates rise more than like 60 basis points or something like that, that it really hurts the equity markets. And that is essentially what has happened, right? The stocks haven't completely responded yet, though, right? So if the stocks were to go down to where I would expect them to be based on where the bonds are, then we have a long way down to go in the equity market, right? But it remains unseen whether that will happen. One thing that I would also note, so there was a really great story about this on Zero Hedge this morning. They were pointing out that, like, with an ETF, you can have the flows going a different direction from the overall price movement, and that can kind of represent or present itself as an arbitrage opportunity for the ETF itself. And one of the things that has been happening in the treasuries in the TLT is that people have just been selling TLT like mad, like just absolutely been going ham with it. And part of that is probably that because the treasuries were down so much, that people are doing tax loss harvesting right now. You take the loss on that so that you can mark it against your taxes and so forth. So I think that there's a couple of things going on that suggests to me that the decline in the treasuries is overdone. I'm not going to say that, like, it's guaranteed, you know, I'll be really careful about, is it guaranteed or not guaranteed, or like, what's the percentage chance of that? Unfortunately, I just don't have the data and metrics for me to really know. All I know is that it's a place of interest, right? It's a point of potential. The treasuries and the dollar are like the two places of greatest opportunity that I see right now, and we'll see how it goes. Well, as I'm saying that, the treasuries have decided to kind of rise up to the height of the day, so. Let's see here. Waller, filling out the December SEP was a very difficult problem given policy uncertainty. Monetary rules are a good check on judgment, but should not be used exclusively. Current rates are restrictive, though not tight enough to cause a recession. Okay, but what if they're over 5%? Is that tight enough to cause a recession? How high do the interest rates have to go to cause a recession? I'd like to know. If you could give us a number, mark that on my chart. Okay, so now that we kind of got like the beginning stuff and the beginning questions out of the way, Omar, welcome to the stream. I'm thinking about my algorithm now. So yesterday was going through the algorithm and I kind of looked at a couple of changes and so forth, and because the issue is, like, I fully admit that it is something that is overfitted, and that it is likely to be a strategy that at some point falls apart, doesn't do very well. But the problem is that it's not trading during our session in the way that I would like. I would like to see something that it's like taking multiple trades per day, and we can kind of watch it and be interested in what it's doing. But this thing was doing stuff like yesterday, you know, it was holding and was taking a full stop against the down move, right? Like well after any reasonable retail day trader would have given up on it, right? And so I'm like, oh, okay, well, so what we need to do is, like, when the moving average changes, we need to get out essentially and start looking the other way. But if you do that, then the results that you get are mostly a function of the moving average and not, you know, the smaller back and forth. So yeah, I don't think that algorithm will give us the kind of the interesting action throughout our trading session that I'm looking for. So I think I'm giving up on that one. I suppose one of the things that we could do is we could just run the algo that tries to run with order flow imbalances. That one's a little bit more serious, right? But I think I need to write something here to let it know things about, you know, how many days left till expiration and things like that. And, you know, have it adjust based on that. Fortunately, we don't have a whole lot of data to go off of for that sort of a thing. I'm thinking about that. Oh, why is my delta here in PS all screwed up, by the way? Let's move this back over to here. Very interesting here in the treasuries, pushing the highs now. Almost to buyer cost basis at 06. See if they can maintain this velocity through that. Doesn't look to me like a super extreme. Well, actually, so what's happening is there's steepening in the curve, and it's happening mostly on the short side. I was going to say, like, the change in delta in the 10-year isn't that extreme, so. Which also kind of has me wondering, like, maybe what I need to do is I need a system that looks at the order imbalance between all of the treasuries Do I need to include the 2-year? I'm not sure I need to. Maybe it's just the 30, the 10, and the 5. And then also look at the changes in the yield curve between that, and then use that to determine when there is an imbalance that is significant. That would be a complex enough thing that I think I would have to use machine learning to do it algorithmically. But that is kind of what I think I do when I'm watching the order flow. So, still more work to do, I guess. You can do it in Bookmap. Okay. Do they even have a backtester? Well, when I say imbalance, I'm talking about this window, this rolling window that I've developed. We could write that for Bookmap, but I don't think that they have it. They certainly aren't saving the order flow historically so you can backtest off of it. What Las Vegas Cybertruck bomber used ChatGPT to plan attack outside Trump hotel? Police say what? Oh man, okay. Well, they are coming. They pushed through the 06 a little bit and came right back to it. I'd say the behavior around our lines today is a little bit unusual. So, first of all, the stop out zone was awfully close, right? And just didn't matter. Okay, on trend days, like, this line doesn't matter. So that tells you something right there that, like, we were having a real trend down, right? Okay, we did bounce right there. Kind of seems like that when you come back to it, that they tends to be a hard bounce off of it on the first one. But then they've gone through it. Probably in the larger picture that it's going to seem like the lines don't matter, right? Unless it does that. But I don't think that's what's going to happen. Who knows? That would be awfully crazy if that's what happened. Seth, do you know a good resource to study more about market microstructure? Well, so if you've already read Traits, Quotes, and Prices, Financial Markets Under the Microscope by Jean-Philippe Pouchot et al., then after that, then you want to go to archive.org. Ooh, let's go. I haven't been there this month. Let's go look at archive.org. Trading research, quantitative finance. Archive.org/archive/QFIN. Trading and market microstructure. New, recent, current month. Let's check recent. Market making with fads, informed and uninformed trader. Oh, this sounds interesting to me. Position building in competition is a game with incomplete information, yes? LLM powered multi-agent system for automated crypto portfolio. And strategic learning and trading in broker mediated markets. We're getting more and more machine learning stuff. Okay. This one is by a bunch of people I'm not familiar with. We characterize the solutions to a continuous time optimal liquidity provision problem in a market populated by informed and uninformed traders. In our model, the asset price exhibits fads. These are short-term derivations from the fundamental value of the asset, conditional on the value of the fad. We model how informed traders and uninformed traders arrive in the market. The market maker knows of the two groups of traders, but only observes the anonymous order arrivals. We study both the complete information and the partial information versus the control problem faced by the market maker. In such frameworks, we characterize the value of information and we find the price of liquidity as a function of the proportion of informed traders in the market. Price of liquidity is a function of the proportion of informed traders in the market. Lastly, for the partial information setup, we explore how to go beyond the Kalman-Busi filter to extract information about the fad from the market arrivals. Interesting. So there might be some information in there that we could perhaps adapt. Trades, quotes, and prices is a gem. Yes, but all of the information comes from studies like these. Trades, quotes, and prices is basically just giving you a summary of all of these trading and market microstructure studies over the past like 30 years. So, you want the latest stuff, you go there. That's all I'm saying. But if you haven't read that book, then you should start with that book. It's coming back. I think I'm going to take a tepid one here. Body bag. The more resources I skim through, the more it appears that all these trading philosophies fly in the face of basic market supply versus demand. I'm not entirely sure what you're trying to say there. Because you're talking about trading philosophies and I'm not sure which ones you're referring to. But then you refer to supply and demand, which is also kind of a market philosophy misappropriated. Like, okay, so supply and demand is like, here's how many of a particular thing there is out there, and here's how many people are trying to buy it. And that's like an economics concept that you can apply trading macroeconomics. It's something that if you are a commodities trader and you are swing trading it, that you might use. But if you're talking about day trading, day traders tend to misappropriate the term. It's like, it went up, so that must mean there's more demand. It went down, that must mean there's more supply, or they changed, or how did that work? Like it's a continuous double auction. It's more complicated than supply and demand, actually, right? It's kind of funny because the whole thing is that the price tends to rest at the place where supply and demand are at their minimum. But what I do see is the more research that you read, the more you'll see that the price on short time frames is incredibly statistically efficient. That is to mean you can analyze it any way that you want. Very difficult, if not impossible, to find a statistical aberration that will result in profits for you. Now, when you look at order flow, there are definitely some statistical aberrations in there that, from what we can see, are caused by how the market, by the rules of the market. By the rules of the market and the fact that there are very large institutions trading large size that is much larger than the amount of liquidity available. Okay. Those inefficiencies, you're only going to be able to take advantage of them if you're really, really fast. Right? But you might be able to take those things as a base, combine that with information that you have, like that article was talking about, being like an informed trader in that situation, right? And work something out with that, right? For example, a volume market profile trader claiming to trade on market auction theory will later in a book discuss some odd concept that has nothing to do with supply and demand. Well, yeah, I mean, market profile. I think market profile is a really interesting one because these were people that were looking at real data and were noticing something interesting about the market. That the market will kind of go through these periods where it will be stuck in a range, and then it will go through periods where it's trending really, really hard, right? And what's with that? And so they kind of came up with this whole thing that, like, the market is an auction, and that it will continue to auction higher until, you know, the buyer is bought the highest price that they're willing to buy, right? It was a theory. That theory is wrong, but it was a theory based on real observations, right? But that's like the whole thing is that up until the 80s, you didn't really have this sophisticated enough data collection to actually really look at the markets, model them, and really prove and disprove theories. So all people had to work with was like logic, like deductive logic, essentially. And the problem with deductive logic is there can be information that you're not aware of. There can be errors in your logic. There's all of these particular things. And so, like, the way that science works is I might use my deduction to come up with a theory, and then I test my theory against the world. Right? Like, if I have a theory that the acceleration of an object is independent of its mass, right? Then I can go and I can drop a bunch of different objects in a vacuum and find that they all fall at the same rate, right? So that's empirical evidence. And anybody, if they have a vacuum, or you know, objects that don't have a lot of wind resistance, right? Because you can drop a feather and a bowling ball and they'll fall at the same rate, right? But air makes the feather float, so maybe you have to have something that's not quite a feather. But I digress. You can test this stuff, right? You can go to the facility, drop them, and see. There's YouTube videos about this where they do these things, right? And you could go and duplicate those results yourself, right? It wasn't until recent that people really had the ability to go in and do that kind of analysis from the market. Say, here's my theory. Now, how would I prove that theory? What kind of data would I need to see from the market to prove that theory correct? And then you'd go and you'd do the test against the market, and you'd have to do it over a large enough amount of data, right? And before computers, it was just not practical, because you're talking about numbers in the tens, hundreds of thousands, if not millions, right? And that's what happened was all of these ideas about the market developed before that. And now that we have the actual ability to do this analysis, people don't seem to be interested in the actual data for some reason. Isn't that weird? Hence, books like Trades, Quotes, and Prices, not really very well known amongst retail traders. Okay, well, it looks like I will get filled on that second lot. Or I guess third lot. Although, well, I will take the fill, but the way that the flow is flipped around here in the 10-year makes me not very confident about whether or not we'll come back up. I think that this flow here has kind of contradicted the original flow that got me interested in the move. Okay, Mir, what do you think is the reason why Bryce hits the stop and then moves in the direction of analysis? Is it a cognitive error or is it just a coincidence? I don't know. As far as I know, it's just a coincidence. It very often seems like, okay, I have reason to believe that we're going to move up, and then you get in a trade, and it will go to the point where you decide that you're wrong, and then it will end up moving in the direction that you thought it was going to, right? The problem with that is, have you actually tracked that like 1,000 times, right? Like we don't have enough data to make that kind of conclusion. What we are seeing, where it feels like I'm always right, but you know, maybe I'm early. That may just be sorry, what do we call it? Confirmation bias, right? I'm only seeing the ones that I want to see. that because of my, my own ego and I want to be right, I will only remember the times when I really thought I was right and ignore the times when I was just completely wrong. And without having a really large amount of data, probably more data than as long as I've been trading, to really analyze that and really find out for sure, Yeah. Bodybag says these profile traders claiming a market needs to repair a poor low/high or single prints or these other ridiculous terms. Exactly. So this is exact. So when I say market profile is wrong, here's what I mean by that. Market profile, their idea is that the market is an auction. So the way that the popular conception of an auction is, a auction where they put the item up on the stage and then the guy is like, do I have $1? Okay, there's $1, $2, $3, and it keeps going up and up and up and up. And then the person that's willing to pay the highest amount is the person that wins the auction, and then that's when the auction is over. And that is their idea of an auction. Okay, we use the term auction more broadly to describe a number of methods of determining price. For instance, there is a Walrasian auction where everybody puts their orders in, and then everybody is filled all at, they match everybody all at the same time, for instance. Okay. What's really happening is there are large institutions that want to buy or sell a large amount of that asset, and the amount that they want to buy is significantly more than the liquidity available. So in order for them to fill that order, they are going to move price. So the reason that you see in crazy trends is because of these large orders. Now you might say, well, Seth, that sounds like a nice theory, but how do you prove that? Well, I'll tell you how we proved it. First, people thought, well, maybe these trends are created by I see that it's going up, so I buy too. So they went and they have these models where this sort of thing happens in physics, right? Like in physics, nuclear fission works this way, right? You have one neutron explodes, and then, one atom fissions, and it shoots neutrons off, and then those neutrons go off and hit other atoms, and based on how dense things are and everything, do you actually create a chain reaction or not? And how do you manage that, right? So they took those models and they applied them to the markets, and they said, okay, when we apply that to the markets, do we see the kinds of trends that we see in markets? And we did not. The way that it behaved in the models is not the way that it was in the market. So they had a theory, they modeled the theory, then they compared their model to the market data, and they found that the market data did not match up with their model. And they tried a bunch of different models, and they had a very, very difficult time trying to find a model that matched this market behavior. And then what they did is they said, oh, hey, what if it's just one guy? What if it's just one guy buying a ton of something? Then, and how would they carry that out? And when they modeled that, then they were able to show all of the stylized behaviors that we see in the market. So that's why we believe that that is the case. I would still call it a theory, but it's a theory with a substantial amount of empirical evidence behind it now. And from there, what they started to do is they started to say, okay, so if you are that person, how do you execute that? How do you execute the most efficiently? What are some things that change in how you do it that might potentially impact the market? And that's where we got all of these things like Almgren, Chris, and the square root law of market impact, and all of these things. And then we went and we asked big banks and large institutions for their data. Okay, now we can look at this data and we can see that there was this really big guy buying a large amount of it. And when they do that, what is the impact on the market? Oh, it was exactly what we thought. And it follows the square root law, right? So that's how we know that what actually causes these trends is the really large buyers and sellers. So the high is not caused by the auction quote unquote finishing or anything like that. It's just there's a guy, he has a certain number of contracts to fill, he keeps buying until they're all filled. And so it's completely a function of how many orders do you need filled. So whether we create a finish high or not that's just a random coincidence. That just happened to be when he filled all of his contracts. So based on that, this idea that like we would go back to those incomplete highs, and it's complete hogwash. Yes, based on our knowledge of the markets at least. I would surmise a lot of price movements are coincidence, and leading the pack of coincidences are gap fills. Yeah. Dude, gap fills I think is one of the more so when you talk about gap fills, so that's sort of thing that like you as a retail trader, if you have some programming skills, that's the sort of thing that you can absolutely go in and look. So when a gap is formed in the S&P 500, they are filled like 95% of the time. I think when I did my study on that, and it's been years and years and years, and I don't know if I would even be able to find my code for that or not. I certainly still have it, but it would be hard for me to find. I could only find like 1 or 2 instances where the gap had never filled. But the issue was, how long would it be until it got filled? So here you have something that's like, first of all, should we consider that gaps fill most of the time be like an aberration? Because I think our natural intuition is that like a perfectly efficient market would be that gaps fill only 50% of the time, right? But I'm not so sure about that. But like the bigger thing is okay, like let's build a trade based off of it. Okay, there was a gap that day, so we should buy it on the theory that the gap will fill. Well, yes, 95% of the time, if you hold it long enough, the gap will eventually fill and be a profitable trade. But how far is it going to move against you first, and can you hold that? No, probably you can't. So how do you actually turn that into a profitable trade? I don't see how you do. And this is what I see time and time again, because I think, and not to bash on him or anything, but I think that this is largely due to the popularity of Futures Trader 71, that, you know, especially in the futures markets, a lot of people are interested in these sorts of things. Is like, okay, let's take a spreadsheet of like the open, high, low, close, value area, high, low, etc., and then generate a bunch of statistics about, you know, when this situation, what tends to happen after that, and so on and so forth. And what I find is that these statistics are fatally flawed because they aren't an actual like trade, right? It's like taking some sort of a statistic that you think is an aberration is a very different thing from turning it into a profitable trade. And what we often find is that when there is some sort of a statistical aberration like that, like for instance, the swing high, swing low in the S&P 500 is created in the first hour most of the time. But when it's not, it's a trend day, right? So when that's wrong, you just get absolutely destroyed. And so it actually is efficient on a risk-adjusted basis, right? Because you lose so much more when you're wrong. And those high-level statistics don't express that to you, so then you go and you take the trade and you blow the account or whatever the deal is. There you go. Body bag. It's not just a question of if it gets built, but when. And when you see some huge price movement towards the gap, I think someone is spending all that capital just to fill some gap is absurd. So body bag, what you're saying, like the language that you're using to explain it, and it sounds like somebody that's been watching my stream for a really long time, and I don't recognize your name. So where did you get that idea from? Or did you just read all of that stuff and this is your first time on the stream? I don't. That's a little weird. It's not every day that somebody whose name I don't recognize comes in and starts talking about these sorts of things in an informed manner. But good. I'm also a little suspicious. It's like, is this somebody that's actually been watching me for a long time and is just trying to get on my good side? Yeah, by the way, O2 touching again. You know, you might have a good, you know, I totally forgot about that, Octavius, that the markets are going to be closed tomorrow. Is the market maker in control? I don't know about that. When I say I don't know, I mean, I don't think that I have enough data to say either way. I feel like this was a significant move. This was a relatively significant move, but the change in cumulative delta wasn't that high. So maybe you're right. On the other hand, when we come over here, now we look at the deltas over here, we get something much more. Okay, there was a really big change, and granted, there was a little bit of selling to bring it down here, but not, you know, like this is a little off kilter here. What's with that? Even though here it went up and back down. So I don't know. I think that I'm kind of just taking shots in the dark here today. I took a trade. I'm gonna try and stick with it until I'm absolutely forced to admit defeat. Or funsies. Just, wow, you've been doing this since 2014? I pop in and listen occasionally, but my final point of gap fills is it is more of a product of coincidence than intention. Maybe. I mean, I guess, you know, one of the things that's kind of weird is, like, if it's a coincidence, how do you prove that something is a coincidence? I'm not sure in this kind of context that you really can, right? I can only say that I have no proof that it's intentional. So if I've tried every reasonable explanation that it's intentional and I can't prove any of them, then the only other conclusion must be that it's a coincidence. But that's not like a positive proof of that, you know? And the issue that we have in trading, I think, especially as retail traders, is that most of the time we are so short on information that most of what goes on is like that. We can't prove that it's intentional. Maybe it's just a coincidence. But maybe if we had more data and more information, we would see that that's not true. At the same time, you have people out there that they're saying that it's intentional, but it's like, okay, but what kind of stuff do you have to back up to say that that is? You've just decided that that's the case. You just randomly decided that that's the case and ran with it without proving it. Copper is on a run right now. Gold is on a run. That's kind of curious because the dollar kind of just seems just okay. This movement lately around O2 does kind of seem like a liquidity hole, and this is maybe kind of them messing around. So that's also why I'm kind of a little bit like, let's just kind of see if we can write it out. But at the same time, when I took the fill at 03, I remember I said, like, I don't like it now. Like, it seems like that we had a counterflow. What? I haven't really done all of my process here, because what makes me think that it's going to buy? Other than that, I just kind of feel like that the treasuries are oversold in general. Okay, logic speaks to otherwise, why are there still unfilled gaps in the market? And if they are intentional, why do some get filled immediately and some are not? Well, so for the first one, I think you could say if there is some sort of property about markets that makes gaps likely to fill, that wouldn't mean that they would have to fill all the time, just that they would fill most of the time. But your second point, I think, is a good one, that why is there such a wide array of outcomes? Like some they might not get filled for days or even weeks. Well, I guess that's kind of just a function of liquidity, but then that still kind of comes into the, like, maybe it's just a coincidence. Right? Like, I guess what I'm saying is I don't know if I can put that in a paper and say gap fills are a coincidence, QED, you know, publish me, right? Whereas some of these other things, it's like, here's the model, here's the market, they match. We'd have to come up with some sort of a model about what causes gap fills that would result in certain statistical aberrations in the way that gap fills happen, and then we'd have to show that the market exhibits those behaviors in gap fills. But we don't really have that, do we? We just have, like, there are gaps sometimes, and they tend to fill. Yeah, to think some player is spending a ton of capital to move a market just to fill a gap left days ago or to repair. Sure. Okay, so let me rephrase. I think that the theory that somebody is sees the gap fill and is making that as a play, I would agree with you. I think that the data that we do have about the markets and the things that we have proven about the markets, that directly contradicts what we know about markets. So that theory, I think, for sure, I think that we've falsified. But that doesn't falsify the theory that there is some sort of statistical aberration that causes gap fills. Just that particular explanation for it isn't a good one, right? Because I'm thinking of it from the perspective of, okay, people in chat are talking about gap fills. Can I construct some sort of a statistical test that I can program up for them and show them? But the discussion that we have here, I'm not sure what it would be, right? And I find that I'm pointing that out because that's kind of the mistake that I think a lot of retail traders make, is that they will adapt these philosophies about the markets that aren't really testable. They're so amorphous and vague that you can't really test them. And any kind of thing that I will come in and do to try and test it and show to them that it's not a thing, it just results in them, you know, going a step further, like, well, you have to do it in this situation in all of these different qualifications. And then it's like, well, we can do those too. But there's just, like, nothing you can ever do to convince them, you know? You're too smart, body bag. You're like me, right? You're just like, yeah, well, like, these are probably all nonsense, right? And you just dismiss it out of hand. But how could we actually do it in an empirical fashion is kind of, and not just the philosophy, but like the piece of data or the area of that data that people are talking about, right? Because what I find often, okay, let's see here. As a hypothetical, I can block out candles on any chart, creating a gap, and they will get. Okay, that might be true. Okay, so now I think that you're hearing what I'm saying for sure. So could we say, okay, here's a gap fill, and what is the percentage chance that we will fill the gap? And then we come back and we say, as a null hypothesis, if this is just random, then the percentage chance that you will fill a gap will be the same as if we were to create our own artificial gap, to just take one candle on the chart and or a certain range in the chart and just kill it out, right? And we could say, based on the size of the gap, here's the percentage chance that it will get filled, and or the amount of time that it will take to get filled. And we can see if the real gaps exhibit a different percentage chance from our fake gaps. I like that. I could program that. I feel like I'm too lazy to do it at the moment, though. So you know what I did yesterday? Actually, let me show you something kind of weird. Because this is what we were programming with yesterday, and I took it a little bit further yesterday. So I was programming my kind of like the one that's a high pass filter, basically, a strategy that's based on a high pass filter. Oh, we came right back up. I'm feeling better about this. And yeah, I didn't really like it, so I kind of gave up on it. So I went back to, like, maybe I can get it to work with support and resistance. So one of the things that I found with this one is here's support and resistance over the last 5 years. So for those of you that weren't here, this strategy basically looks for a high over a period, in this case the past 100 bars. So if we are breaching the high of the past 100 bars, and there's a certain amount of trend as exhibited by R2, or a lack of trend. I think in this case there's a lack of trend as exhibited by R2. Then we trade against the breakout, essentially. So it's support and resistance. We're finding these spots where it's kind of, you know, it's turned before and saying, oh, we just got there. It's gonna come back in, is what we're doing. And I think that one of the key changes that I made here that I think was really valuable, and goes back to this thing that Body Bag was saying, it was like, okay, like, let's just, you have like too many variables in here, so we need like something that's random. Like, can we compare against random? So one of the things that I was finding was like, well, whatever I do, whatever I'm optimizing on, what I'm actually doing is I'm overfitting it to volatility. That, like, it will either try and take the most amount of volatility it can, or the least amount of volatility that it can, depending on, you know, whether the strategy is mean reversion or trending, and whether it's profitable or not profitable, or whatnot, right? So what I said instead was, the exit is always going to be after 5 bars. And you can change it there, but that's what this exit bar says. So in this particular case, I'm saying, I will take the mean reversion and I will close it after 5 bars. Okay. So when you do that, you do get a profit after 5 years, but it's only teeny tiny little bit. When you look at it, it's like half a percent edge. And what you find is, when you include commissions and you add 1 tick of slippage to it, that it's a failing strategy. Okay. Well, we take those things out of it, it looks profitable. Okay. But then I started to look at things like the well, okay, so the net profit, I think it has to run here again. Hold on a second. Yeah. It's worked mostly in this most recent time period for some reason. So it's like, it was kind of interesting that it was like, oh, why is it that it worked so well in 2024, but not necessarily in other times? But then there was also this thing with like, this one right here, the optimization. Yeah, let me run this. So we can look at the cool looking graphs. Dude, am I gonna get filled on those initial little orders? I'm like, so that's so crazy. If I do, that should put my cost basis almost to that swing low at O2. Why did you choose the high-low pass filter? Okay, so the reason I chose the filter was because I see a lot of people on Reddit claiming that they are profitable. And by and large, my observation has been that the people that claim to be having this success seem to be using mean reversion strategies of some sort. That they're coming into the S&P 500, they're seeing which way the trend is, and that we've had a little bit of a move against the trend, and then they just take this tiny little trade, and they have like a super tiny little profit and a huge stop. And so when I look at those strategies, like the big red flag going off for me is, oh, they're making money from taking on risk and not actually from finding some sort of a predictive feature in the market, right? So I want to have an algorithm that shows that it wins most of the time and everybody thinks that it's absolutely awesome, and then it just starts to do awful. Something that like you could go and pass a funded trader program with a pretty good percentage of the time, but that if you really trade it for 5 years, you're not going to make money from it. That's kind of what I'm trying to accomplish. So what I'm looking for is I'm looking for a candidate for Operation Johnny, which is basically, can we create an algorithm that is consistent enough at passing the combines, but unprofitable in the long run, that it really causes funded trader programs issues, because you have all of these people coming in and making money from passing these funded trader programs and getting payouts, but then they can't just go and arbitrage the market and, you know, trade it on the actual market, because then in the long run it's not profitable. You see what I mean? That's what I'm trying to create. So it doesn't have to be a profitable strategy per se. It just has to seem good enough, right? It just has to be profitable enough over short periods. So what I'm really looking for is something that goes like this, right? I'm looking for a profit curve that's like a sawtooth. Here we go. So when I start to do these graphs, then I get something that is like really strangely distributed, right? Like if I say, okay, how long of a look back period should I look for the high and low, right? How long or consistent of a range does it need to be? Does that change things? And it doesn't. I don't know if you can see those blue dots, but like it's all over the place. It's all over the place. okay, does the amount of does the look back period for the R2, does that change things? Well, it seems like it prefers it to be a short term. So it doesn't like it when it's been no trend for a long time, but it does like it when it hasn't been a lot of trend short term, but it's still like a really broad range, essentially. So when you start to make these 3D graphs, R2 period, you get these really weird looking graphs that I'm not sure you can really actually make sense of. They kind of do some weird things. Like there's this one spot where it clearly seems to be worse. There's a period of about 140. But who knows? It's just weird things like that. In all my years, all the traders I met, self-proclaimed mean reversion or counter-trend traders, are pompous. And yeah, that has been my observation too, is that the counter-trend traders are the ones that are, well, you know what I think it is though, Body Bag, is I think that if you've made money in the market, if you've made tens of thousands or hundreds of thousands of dollars in the market, changes people, man. Like once you've made that much money, the human mind says, I am a fucking god. Like I have solved the market. I am all of the things. I am smarter than everybody else. I think that part of this delusion comes from the thing that I try and talk about every day, the idea that the market is perfectly efficient. So if the market is perfectly efficient and you are able to find a gap in that market and do something that makes money from it, then that means that you're smarter than everybody else. That is the market christening you as a smart, profitable person, right? And once somebody thinks that they have achieved that, they develop this ego, and nothing that anybody can ever say or show them will ever convince them otherwise. The only thing that can destroy that delusion is for them to blow the account. Because then that is the market saying, actually, no, we don't like you anymore. Right? And the story that they'll make up in their mind is, well, it still works, but I just made mistakes, right? That's what they'll say. Yeah. So yes, I'm explicitly trying to create a strategy that copies what they do. Well, this mean reversion one, I think is a better approximation of that sort of stuff. But you know, when you look at the summary of it, I already changed it, but you saw it. You know, it's like the edge in it is so small over this 5 years. I really don't think it's that interesting to trade. You know, because part of it is I just want the entertainment of watching the algorithm play out, you know? And I don't know if that would actually be that interesting to watch. There were some things about the one that was really trying to like the high pass filter sort of a thing. So it's really looking at like all of the different swings in the markets and saying this one and this one is odd and we should get a little bit here and a little bit here. It was more interesting. But then in order to get it to the point where it seems to perform the way that we're looking for, I have to add other things on top of it that make the trades too big and it doesn't provide the entertainment value. So I don't know. I don't know where to take it. I'm kind of like, hey, maybe I'm going to give up and I'm just going to go to work more on the algorithms that are based on order flow that I think will actually work, you know, like that I hope will actually work, but that we need more data. If a dude can screw 6 figures out of the market on a regular basis, well, but that's the thing is like maybe they did it one time, right? Because the whole thing is that they go and they make the money, and then they turn around and they tell everybody, hey, this is how you do it. It's easy. It's just support and resistance, yada, 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 yada. And the reality is they were just lucky. And everybody else that tries it fails at it, right? And then you tell them that's what's going on and they don't believe you. And so how would you prove that? Well, if I had an algorithm that did that, then I could show them that, right? Yeah, they make 7 figures selling a course, I guess. I got this email the other day from somebody. They wanted a ton of money to help me develop a course and sell it. And I'm like, I'm not really interested in doing that. I mean, like, the larger thing here is, so here's another thought on this sort of thing. Because I sell indicators, and one might say, well, but if it's really so great, then wouldn't you just trade that? Well, yes and no. So no, like, one of the things is that there is a lot of evidence supporting these strategies and like ways of looking at the markets and everything else like that. But I don't necessarily have the capital or the necessarily even the risk appetite to really take advantage of it. You know, I think that some of you guys do. I think that some of you guys, you're going to take, or I've seen people that take the indicators and they do way, way better than me. Part of it is because they're willing to take the risk on, right? But then the other thing is that really what I'm saying is like, hey, everybody's been mining over here. This area is all mined out. There's this other area that hasn't been mined at all. And I'm going to give you the tools to get there and to actually investigate it, right? So if that's really what you think is happening, like, think about the mine rush, right? Everybody is in California mining for gold in California and not finding anything, but you know that there is gold in Alaska. So if you know that there is gold in Alaska, what are you going to do? Are you just going to move to Alaska and start panning for gold in the river? I mean, I think that that's what most people would do, but I feel like that's a small brain thing. You know, I feel like if you know that there's really that much gold in Alaska, shouldn't you be doing everything to like raise some money and build up a huge expedition and buy up tons of land up there and doing all of these sorts of things? You know, like, if you really know that there's gold in Alaska, you should be building an empire before everybody else figures it out, right? And so that's really what I'm trying to do is I'm saying, okay, I'm really good at software development. Like, that's the one advantage that I've really got on people, or at least the biggest advantage that I can leverage. So if I have something like this, in this case, or, you know, real analysis of order flow and doing like a real scientific study of historical data, then what I should be doing is I should be building this thing, you know, that I'm going to make more money from that than I am from, you know, just panning in the river with it. Get what I mean? So, I don't know. You kind of got to work with what you got. I don't have hundreds of thousands. You know, part of the thing is that, like, if I had $100,000, there's a couple of things that I've kind of seen and investigated about in the market that so like, I think that you could make a decent amount of money or a really consistent amount of money trading that. But you'd have to have a lot of money. Like, this is the issue that I keep. The real problem is that the biggest kind of inefficiencies in the market that we see, you can't really take advantage of it unless you're doing it at scale. Like momentum is a real statistical aberration that we show in the market, a real inefficiency, one that I think will probably always be around in some fashion, although it will cycle, because there will be people will come in and trade it, and then those people will get washed out, and then, you know, we'll kind of go in this cycle. But I think that the momentum effects will always be there because it is a structural inefficiency in the market. But you can't do it unless you're doing it at scale. You need a lot of money to start with. I would open a supermarket and sell a loaf of bread to the miners. I was watching this movie on TV once. I don't know why. I don't remember the name of the movie. I don't remember really anything about the movie at all, the characters or anything. In fact, I don't think that I even watched the whole movie. I think I only watched a portion of it. But these guys, they were in a mining town and they're trying to pan in the river. And there was some people that found a lot of gold at the beginning of the town. But then what happened was a large corporation bought a huge swath of land north of where the town was and owned the river. And they were basically like taking water from the river and pressurizing it and turning it into a huge hose and then just spraying the hillside with the hose and washing all of the dirt down the hillside and into this huge mechanical apparatus that they had to pan for the gold instead, right? So they were panning for the gold at like this insane scale. And it was like, and there was this one guy that he was working for them, like he had given up on trying to do it himself and he was working for them, right? And that scene always kind of comes back to my mind often. That it was like once the corporation came in and started doing this at scale, all of the people that were trying to pan for gold in the river didn't stand a chance. And it was when you kind of put that in there, it was kind of like, if you really knew that there was gold somewhere, why would you just pan for gold? Or why wouldn't you try and go and do it at scale? You know? Last I checked, that's illegal now. Oh, I bet it was extremely damaging to the environment. Yes. But this was all set during like the California gold rush, right? This was like all old Western times. Some movie. Is it a Clint Eastwood movie? Maybe it's a Clint Eastwood movie. Let's see here if I search for that. I'm reading the synopsis really quickly, and I'm like, I should go watch this movie. This sounds like an interesting movie. 1985. This is Pale Rider. It is about a gold town. This does kind of sound like it, because I remember this part where like a guy actually does find a nugget and then he gets shot. Yeah. I might go and it could be Pale Rider, but when I search for it on Google, I get a bunch of different. Have you ever looked into using the market on close order info the last few minutes of the session exploiting the imbalance by trading into the close? Yes, I have. So after the pandemic, they closed the trading floor, or not after, during the pandemic, I guess you could say. They closed the trading floor for a long time. I'd say it was over a year that the NYSE floor was actually closed. There was still electronic trading, but there wasn't the trading on the floor. And what happened during that time was that situations where there was like, it used to be that people would have an idea of what the MOC was going to be, because there's a lot of people that they don't submit those orders until like the last second before the deadline, the 10 minutes before, right? But like the market, when people are on the floor talking to each other, they're able to kind of like sniff it out and know what it's going to be. So when that MOC comes out, it's not a surprise to them, right? Well, during the pandemic, they weren't on the floor, so they weren't able to do that. And so we had these situations where every day, 10 minutes before the close, that market order imbalance would come out, and there would be this huge move in the stock market because they weren't expecting it. And the number came out was like way wide, far away from what people were expecting, right? So I definitely did a lot of research, I actually have a video about it, and if you really go back, and I explain everything about how it works and all of those sorts of things. During that time, there was a real kind of, you could definitely make money from it, because there was kind of this whole thing that like, there was still very bearish sentiment, but the market was recovering, and we were in this kind of period where we had like one of the most insane recoveries of all time, sort of a thing. And so you could just buy. I mean, overall you could just buy, but then you could also buy in front of the MOC, and more often than not, you would make money from it, because it would end up being much heavier buying than they were expecting, right? But you know, as time went on, it kind of seemed like that they fixed that. They fixed that. And so I would say that if you are trading the S&P 500, especially around that time period, it's something that you want to be aware of and watch. There's also orders on the open, so there's kind of an imbalance you can see at the beginning. That can kind of help you give a little bit of an idea about like how much of the action that we're seeing right now is from those people that just trade the start and end. But I don't know how you would make a consistent profit off of it other than that. Not without having a lot of data that we don't have access to be able to predict what the market on close is going to be before it happens, you know? So oh, dude, this is it right here. This is totally it. I found it. Totally found it. It is, I think this is from Pale Rider. So see, they've got a huge water cannon and they're just shooting it at the side of the canyon wall to push all of the dirt down. I'm just saying, like, if you know that there's gold in Alaska, why are you just going and grabbing a pan? Like, that's all. Maybe I'm thinking too big for me, but that's why I have the approach I do. See, or whatever you're testing there, I don't think it's working. Or are you talking about the back test that I have in the back here? Yeah, it doesn't actually work. I was already explaining why it's not very good, yeah. If you pull it back over here. Come on. No, that's the optimization. You want this one. There we go. No, not tick replay. Oh, it does have save history on there. Okay, so here's the performance of it over a 5-year time period, right? Now, if I come on and I include commissions and run it again. Dun, dun, dun. It doesn't make up for the cost of commissions. So it's like, I'm sitting there like, okay, so if you trade support and resistance, there's a 0.5% probability on you, but that's not enough to make up for the costs of trading. Basically. Yeah. I think I'm not done on this concept because I really like a lot of Euler's work. Or Eller's, I don't know how you say him, John Eller's. And this was an oscillator kind of based on him. I think that the oscillator is really, really interesting, and maybe I'm just using it incorrectly. So I think I need to read his stuff and see if there's something that would make more sense. Because part of this, again, is I'm not looking to make a profitable algorithm with that one, but I'm looking for something that appears profitable, right? Looking for something that, you know, for somebody that's trading over a year, it probably looks amazing. That it can have a really good run. That's what I'm looking. I'm looking for something that's not profitable in the long run, but has really good runs. I want something that does this. Right? And I want to be able to come and have this be like $50,000 and then come in and show people and be like, look, this made $50,000. We traded it. We had the $50,000 in the account, and then what happened? Boom. It all died. Yes, to troll the prop bros. Exactly. And then what we'll do is we'll give everybody this and we'll say, hey, look. Here's what's going to happen. It's going to do this. When this happens, you're going to lose your account. You're going to lose your prop firm account. But you will have still gotten all of these payouts, right? So then everybody will go and trade this thing and the prop firm won't be able to handle it. Because they'll have to be giving all of these payouts to people, but then they can't just like mirror the trades or force them all to trade live, because then they get screwed when the accounts get blown. That's kind of the idea. So if you have some thoughts on something like that works like that, let me know. Dude, are we gonna break this range now? I look like a fucking genius now, don't I? You know what though? Like, oh my gosh. This is so weird. Because the way that this whole started was I took the trade. I said, oh, I do think that we're going to be up today. It looks pretty good. I saw the possibility of it coming back, so I had a spot where I was going to add some more. And then it went even beyond that, and I'm like, oh, now I don't really like the trade. I like the way that it played out. I don't like the trade, but I'm going to stick with it anyways. And we were all talking about, why do you get this thing where it's like your analysis ends up being correct, but they're going to go and stop you out first? And that's exactly what happened. That's exactly what happened. What, is it just a coincidence? I don't know. To me, it sure doesn't feel like a coincidence, but I know that that's almost certainly confirmation bias, right? Well, maybe it's not confirmation bias, because I do think that there is somewhat of an actual edge to what I was doing there, right? Like, I did have kind of an idea about the way that the action has been the past few days, the selling being a little bit overdone, and the moves that that moved us down in the news and everything, and then me seeing these buying flows coming in afterwards was kind of what made me say, okay, like there are some people that actually need to buy here now in spite of all of that, so I'm gonna try and go with it. And maybe I just got lucky, but that's why I took it. So whatever. Kind of, the whole thing kind of makes me want to go mining for gold, actually. That sounds like that, well, as a one-time thing, that might be fun. YouTube is also recommending to me Roaring Guns. Oh, this is an old movie. I don't know where this is from, but I'm pretty sure this is the movie that I was talking about. They're hydraulic mining. They take the water up into a high spot to create pressure and then shoot it up at the mountain. This doesn't say where this excerpt came from, though. Okay, so... Oh no, that's kind of interesting. I didn't notice this on the way back up. Well, so first of all, we took it at... we took it right here. We took it right here and then another contract here. I find it interesting that they did a little bit of a dance in between the two sides here. I'm not seeing like a huge increase in cumulative deltas, so I may have just gotten lucky. May just be market maker fooling around. But I already took profits on you know, a few contracts to get my cost basis way down here. So I think I can just kind of leave it alone until the end of the session. Do you take breakouts or failures? No, I don't. I don't base it on any of that. So I explicitly avoid trying to base my analysis on anything having to do with past price movement. I will look at past orders. I will say there's been a persistent imbalance in market orders in favor of buyers. But price movement, no. So that, like a breach of the opening range or a previous day's value area high or anything like that, I explicitly don't look at those things. I've backtested them. I was not able to find profitable trades with it. I think that most people, they are, you know, they don't really have anything there. And so I avoid basing my trading on any of that. I'm basing my trade more on like informational things that you're not going to see on the chart, right? So let me try and game this particular trade out for you a little bit better, right? So here's the chart. First, let's go back and let's look at a larger chart though, okay? We've been on a bit of a downtrend since the beginning of the year. We had a pretty big down move yesterday when we had some news like the PMIs and the JOLTS claims that really shoved us down yesterday. Then this morning we had, let's see here, initial jobless claims and what was it? Oh yes, ADP. So ADP was much less than expected, but jobless claims was better than expected. Or no, jobless claims less than expected. Both of those are things that are like, well, initial jobless claims, that's kind of hot, and ADP is kind of cold. Okay. So the ADP though was not necessarily this big down move. I'm not 100% sure what caused this big down move, but we were retracing it and we had a Fed speaker. And then after that, I started to see that change. Okay, so let me come back here and show you that change I'm talking about. Okay. So starting from here, right? When we're above 50%, let me put a line on here for you. Let me put a horizontal line on here. Horizontal line right at 50%. Okay. So when we're above that, that means that there are more market orders than sell orders, right? So we had this way overdone sell that I really couldn't explain completely. Had a little bit of news, and then we started to get this. So I said I'm gonna buy. I think that we're gonna see net overall more buying than selling. So I bought. Another factor, and we always have to come back and look at this as well, is what's the spread doing? Spread is rising. So if we are steepening, that's up is steep, right? We're steepening, that means that they're going to buy the 5-year side of it and they're going to sell the 30-year side of it. And you can see that. You can see that in the order flow, right? Here in the 10-year, it's kind of a little bit iffy. There's a net imbalance in favor of buyers, but it's a little bit iffy. But when you look at the 5-year, clear market buying. So I know that the spread is going to probably going to continue up, and we're going to be steeping it. And that was all the trade was. And I think that it was very much a gamble. I took like way more heat on it than one probably should. I know. Wasn't the fake news story one of those moves down? Yes. So there was the we're not actually going to do the tariffs, and then Donald Trump said no, that's fake news, and there was some down movement from that. But I think that the big move down was the jolts. Yeah. So I don't know. I feel like that over the last few months, well, like let's say since I got laid off, I haven't been really taking very many, if at all, live trades. But my read of the market has been pretty good. I haven't been taking as aggressive of trades, and I have been taking a lot of it. Actually, let's go and look at the stats and let's see how good or bad it really actually is. So we want to go from basically like the last week of September until now. It is now the 8th. And I think that we have to limit, yeah. There you go. Okay, so it's only a handful of trades. Took a couple of really good ones there in October, though. But yeah, going from here to here, I've only had a few losers, but that's probably going to be more a factor of my MA and MFE. Let's see how bad it is. Okay, 60% win rates. Average winning trade. Oh, wow. I had a loser that was my average losing trade is 348. So I'm really trading a really terrible risk reward. But what about MFE and MAE? That's kind of what I care about a little bit more. Oh, wow. That's actually really good. MFE is 3. MAE is 2.65. I mean, those are not bad. I am taking on a lot of risk to do it, but I'd still say it's not bad. Oh, my comment was about a strategy development that would act like a sawtooth. Do you think that things like trading breakouts of the RTH would act like a sawtooth? I haven't seen that. Actually, my recollection when I backtested those was that it was just kind of like random. I don't know. One of the things is that I don't know if it would be a sawtooth, because there's some strategies that are actually more like this, right? Works really well for a while, then it doesn't work for a while, then it, switches. But I think I would rather have one that's like a real sawtooth. Where when it loses all very quickly. Like, the thing is that when I see people talk about these sorts of things, and I thought, oh, okay, that shouldn't be too hard, because what they're doing is just they're taking on a lot of risk. But trying to duplicate those results in a backtest has been difficult, I'd say. Maybe I'm just too picky. I'm looking for a certain, frequency of trades and all of these sorts of things, and maybe that's the problem. But whatever. I am thinking about volatility a lot more now, though, because it seems to me that if I do a back test and I'm doing things like I'm trying to figure out, is there a period, like what's the optimal period to use for this and all of those sorts of things, that really all I'm doing is curve fitting the algorithm to volatility, and that causes real problems. That was a nice little move up there for some reason. It kind of made me think that maybe there was some news. No, I think that my eye is just catching the movement a little bit more. Because it was only like 2 ticks up. Yeah, okay. I think we're okay. We still got 30 minutes, though. I do need to be careful. I mean, this is kind of like a potential stopping area. Like, I'm going to watch it a little bit longer, but this may be a spot where I just want to get out because I don't know if we're going to get another really good move up before I go. And the next move might be a pullback too, right? So there was some news. Well, there was there was oil, right? It was crude oil, I guess, but what's this from the Wall Street Journal? Who wants me to prove I'm not a robot? The left and right alike are blind to trade-offs, where liberals only see benefits, conservatives see only costs. Economics is about choosing wisely. Well, I think the larger issue is that I think that a lot of our economics are fundamentally flawed. I think that a lot of our economic models are simply not sophisticated enough to explain the chaotic nature of markets. I think that there are institutional biases. Still, article kind of sounds like down my alley. Bet I don't have a subscription either. Okay. See that offer is looking a little weak, but they didn't take it. Okay, there we go. And then they did a good stack when they did. This reminds me of something. Where is it? Hold on a second. You know what? I'm just not in a very good sync with the news these days because everybody's talking about the forest fires in California. I'm kind of like, yeah, what's new? What's new? We've been screaming for years that the land management in California sucks. Was it this article? Here we go. So Zero Hedge has been posting this this for quite some time, actually, I would say. And they're basically saying interest rates have gone down, but the S&P 500 continues to go up. Well, it's moderated a little bit in the past month, but what's going on with that? And they're calling it an alligator. It's kind of funny because when you look at it, it really does look like an alligator's mouth that's about to go. Okay. The issue is that everybody's assuming that this is going to come down to this, and I don't think that that's the way it's going to work. I think that the treasuries are probably oversold, and that the treasury are, let me get a different color. I think that the treasuries are probably going to come back to this. I think it's going to be like this. I think that the treasuries are wrong and not the equity market, but we'll see. That's just like my intuition of the situation. Tell you what, the S&P 500 does kind of odd action today. So check this out. So you have these big down moves. You kind of have to ignore all of this stuff because the market opened right here. Okay, this is the open of the S&P 500. Okay. What I find interesting, actually, you can see the little line right there. What I find interesting is that we really didn't start to see big changes in market order imbalance, at least here in the futures, until a good 30 minutes into it. So usually that first 30 minutes is like one of the biggest changes. So the S&P 500 has kind of been going sideways here, but the futures have been buying since the open. That's a little bit odd. A really rangy market, but a huge imbalance in favor of buyers. What's with that? There's some sort of huge hedge going on that can explain that. So when I see that in S&P, when like the price action and the market order imbalance don't seem to match each other very well, I'm thinking there must be a hedge going on. But I'm not sure I can really come up with a good explanation for it. Amir says called risk off. Well, I do kind of think that January, February could be a risk off time period. I'm still getting fairly interesting moves and changes here on the DOM in the 10-year, but it's not actually really going anywhere. It kind of pulled back a little bit. You're hearing all those click, like every time that it ticks up and down, you get a bunch of those clicks. I don't know if you can hear those. I've had many people come on and like, oh, there's something wrong with your audio codec. No, that's intentional. That's a notification. I'll see 2 ticks down there. They're messing with it. That's not, that I don't think that that's a good sign. I could be really wrong here, but that kind of suggests to me that like they're trying to stir the pot for some reason. Like that they're not getting enough activity and they're trying to spur activity. And when that happens, I don't want to be involved in it. Right? Dude, okay, so I'm reading this story on Reddit, and I don't know if I believe it. So I tell you what, I'm gonna read this story to you guys, and you tell me if it's cap or not. I don't think it's cap. It looks like it's somebody created an anonymous account just to post this story. But, yeah, okay, anyway, so the title of it is, Getting Rid of Dating Apps Has Been Traumatizing and Eye-Opening for Me. Insane Withdrawals. 27-year-old male here. Since I first became single at 22, after a 4-year-long relationship, I have been on dating apps, Tinder, Bumble, and Hinge. I don't know what it was in 2019, but I literally had hundreds of matches that year. I slept with around 20 girls that year, and it absolutely wired my brain differently. I became somewhat of a sex addict. Craving more and more, I fell into a relationship with 2 different sex addicts off of the app, which was traumatizing since they both had bipolar disorder. I took breaks here and there a couple of weeks at a time, and I felt extremely empty during that time, so I decided to hop right back into those apps. When I got out of a 2-year-long relationship in 2022, I got back on the apps, but my success went way down, like 1 a week. Well, that sounds like typical. So I started getting desperate, paid for Tinder Plus, Hinge Plus, spend hours daily swiping and trying to figure out how to game the system. Had some luck with impulsive women who wanted quick, risky sex, relationship-oriented women who never even gave me the time of day, even resorted to hooking up with strangers off of Reddit. I've always been a relationship-oriented, but have social anxiety with meeting people in person, so I just kept hooking up with impulsive women who would want to go out with me immediately. I just ended my last relationship of a year after finding out I was being cheated on the entire time and decided to do something different this time. No apps permanently. It's been almost 4 months without apps, and I've realized I've been using them to fill a giant hole in myself. I have no close friends nearby, and my relationship with my parents is very strained due to fundamental differences. As a result, I've been feeling so lonely and emotional. I've cried more in the past month than I ever have in my life, and I'm starting to feel I'm talking to myself, dancing to myself at music, at home, and in my car, looking out at the stars, hills, and feeling gratefulness is not all roses. I've developed severe anxiety and insomnia from the loneliness, knowing that there's nobody out there for me if I don't download an app and spend 4 hours a day swiping and hunting. My anxiety still stops me from approaching women, but this is my forcing function to fix it. Otherwise, I'm going to die alone. I've been going out alone and dancing at parties and shows all by myself. I don't approach any of the cute women I see because of the anxiety and now trauma from bipolar disorder exes. But I like just being in a sea of people, getting lost in the music and dancing for hours between New Year's Eve and New Year's Day. I probably dance for 5 or 6 hours all by myself. That is weird. That is a weird story. Story sounds like it could be true easily. The guy also sounds like a bit like a loser. I don't understand how you could have so much roaring success in 2019 and then be doing so terribly in 2024 on the apps. That's weird to me. Has something changed on Tinder between 2020 and 2024? Did the apps like really just like fall apart? Nobody's serious, because when I was using it was 2016. Yeah, I can't find Love Boo, who proceeds to talk about all the parties and other nonsense the guy was doing instead of anything good. Yeah, I totally, I get you. I'm also like, based on the way that the guy talks about himself and everything, I'm like, how did you ever sleep with 20 girls in a year? That's weird. I don't know. Kind of weird. Maybe it's an age thing. Maybe it was that, like, when he was 22, the market is just different now that he's like, what, 27? Humble brag. I don't know. This is just a weird story, don't you think? I mean, I find it interesting because part of it is like, how are dating apps changing the way that relationships are formed, and how are the apps themselves changing? Because I spent a decent amount of time on the apps. I dated a lot of girls on the apps. I'm in Utah, so it's like a different sort of a thing. It's like when you're over 30, if you're both Mormon, you just swipe right. Like, this kind of seems like the way that it worked. And there were more girls than guys, because a lot of the guys fall out of the church or are already married by that point, right? So yeah, Mormon Tinder is wild. But I met my wife on Facebook. So didn't come from the apps. The success didn't come from the apps. I don't know. I enjoyed the people that I met during the time. You know, I would just keep dating them until they would lose interest and go and do something else, or whatever the deal was, you know. People kind of filtered themselves. But I went on a lot of dates. Maybe that is the issue, and maybe the people that were on Tinder really were not that serious about a long-term relationship. I don't know. Probably was also partly me. Like, during that time, I was explicitly saying, well, I'm not going to get in a serious relationship for a bit here. Had exactly a timeline, and I followed through to it, and it worked out really well, actually. But I keep seeing all of these stories where people say that, like, these apps are absolutely, like, been destroyed. That, like, the girls only swipe on the same. I mean, they were saying that back when I was using it too, but you know, the popular culture has really turned against them as, like, they aren't a very good way to meet people, and so there's just not a good way to meet people anymore. You know? I miss the old regime parties and bars and such. You know, that's also a really interesting part of the story, is that, like, the club market really got killed in 2020. It really did. And a lot of Gen Z has been complaining because the party scene hasn't been anywhere close to what it was in the millennial years. And I'm not sure it will ever come back, to be honest with you. Because you just have less and less people. And it was always a risky venture. So in an era of higher interest rates and things, there's just not going to be as good of parties. There's just not. There'll still be concerts, and you'll still be able to go to, you know, your massive. And if you're into that, have fun. But it's just not going to be the same scene that it was before. Music in general, man. Because when I started, I spent, you know, when I was in school in particular, before I discovered the stock market, really, my grind was the music. I spent a lot of time going to clubs, trying to get gigs. Like, that was my grind. And eventually I kind of gave up on it, because I not that I was saying that it was like a give up on it. Like most people, it's like they're into the music and then they grow up, sort of a thing. It wasn't really so much that as it was that I was just looking at the market and the way that the music market was going, and I was saying, this is not a place that I want to be. The way that music works today is not in my favor, and I'm not entirely sure where it's going, but I'm not so sure that it's going in a direction that is favorable towards more people being artists and making real money from it, you know? And now I'm starting to see really crazy stuff. Like, like um Spotify is really changing in favor of those big artists, and all of the smaller artists are like starting to leave the platform. And like the smaller artists aren't making money from it. Even if they do exceptionally well, they're not making money. Like there's people that, you know, I follow and they seem like they're really big names and they're not making squats. And I don't know where that goes, you know? It's doing weird stuff. You're going to see some really big and jarring changes in the music world. Just as big as the change between CDs and MP3s. I think that's where it seems like it's headed, but I don't know where it's headed. Just seems like it's at a decision point like that the current business model doesn't make sense and they're going to shift it somehow. And the way that they're trying to shift it is one that like nobody likes. So I'm not sure that it can do that. But then what's the solution to that problem? Ooh, they got hit there. Oh, I already got out though. What did I get out at? Did I get 8? I hope I got 8. No, I got 7.5. Yeah, well, only 1 tick. That's okay. Let's see here. I missed this comment from Maple. I know a guy, he's a Playboy type with a similar real life story that you just said, and the addiction to random female bodies is totally real. And I totally is. Yeah, totally. You know, I never understood this in my youth, but like once you become married, man, the chemicals start going and you get real problems. Like at first, relationship is very much driven by like the dopamine and the novelty of it, and then over time that gets replaced with like the comfort and stability and all of those sorts of things. And when you mess with those things, it messes you up. It messes you up big time. Because, you know, like you think that there's something wrong and your mind will just, like, it's really hard to focus and do anything. So, not that I'm saying that I've like had like huge life altering problems with that per se, but it's just like, it seems to me like it's something that like everybody deals with to some degree, and the way that our modern society and the way that social media works and everything else like that just like makes it a much higher to it becoming a relatively moderate problem that everybody has to deal with, instead of like, oh, that's kind of interesting, I didn't really think it was a deal, you know? Let's see here. Power came back on for me around 4 p.m. yesterday. Many over still without. Well, look at it this way, eh, Paul? At least your house isn't on fire. We went from one big disaster to another big disaster, didn't we? All I'm seeing, if I come back, like, I'm sure that the Zero Head front page is probably about California wildfires. Unprecedented fires scorched 3,000 acres in Los Angeles area, forcing 50,000 to evacuate. 49,000 to evacuate. Yeah, apparently it's a big story. r/recruiting hell. Recruiter asked me to join an online interview within 5 minutes of notice. This is a little funny. I got a call from an angry recruiter saying that I had an interview scheduled and I wasn't in the meeting. I was taken by surprise and I was pretty sure that I didn't have any interviews for today. I asked him to clarify and he says they sent me an email. Check the mail. Lo and behold, he sent me the mail 2 minutes before the call. Asked him if he was serious. He was dead serious. Another thing about this, I didn't recognize the company. I read the name and didn't remember submitting an application to them. Well, that sounds like somebody that's really desperate, so that's kind of good for you, actually. I don't know, man. Another peculiar thing, the mail I got was CC'd to me along with 50 other candidates, which I think is very... Oh, what? That is weird. That's suspicious. That is very suspicious. That does sound like a scam to me. Okay, well, there's my ding song. I got some other things to do today, so I will talk to you guys tomorrow. I'm trying to be a little bit more keyed in on the market and taking a few more trades because this is that time of year. And we did pretty good today, although obviously the entry on that trade was terrible. But hey, it worked out, right? I'll see you guys tomorrow. Stay excellent, team.